All right, welcome to The Explainer. So today, we're diving deep into the nuts and bolts of startup investing. You know, when you're raising money, you're not just selling a cool idea. You're actually selling a specific financial thing, a security. And believe me, choosing the right one, that can make or break your company's entire future. So this is really the first big question you have to tackle, right? You need cash for your startup, but what are you actually selling to get it? It's not just your awesome product, no. You're selling a little piece of your company's financial future. But what does that piece even look like? What are its rules? Well, that's exactly what we're going to unpack today. So in the legal world, that piece of the company has a name. It's called a security. The best way to think about it is like the rule book for your relationship with an investor. It spells out everything. What they get, when they get it, and all the special powers they might have on this journey with you. It's the whole game plan, right there in one document. Okay, let's jump into our first section, the 2 tiers of equity. We're gonna start with the most common kind of investment, the one you probably think of first, and that's equity. It's all about actual straight-up ownership in the business. So let's talk about the ground floor, common stock. This is the most basic, fundamental type of ownership. If you're a founder, this is almost certainly what you and your early team have. Now, it gives you a claim on the company's value for sure, but here's the kicker, and it's a big one. You are at the absolute back of the line when it's time for a payout. And that brings us to a really crucial point. Think about it from an investor's perspective. They're taking a massive risk on your big idea. So, are they going to be happy standing at the back of the line with you? No way. To make that risk worth it, they're going to demand a much better deal, a superior spot in line. And that leads us straight to the next level of ownership. And that better deal has a name. It's called preferred stock. Honestly, the name kind of says it all, right? It's preferred. It's like having a VIP pass to the company's bank account. When it's time to hand out money, say, from a big sale, the preferred stockholders get to skip right to the front of the line, way ahead of anyone holding common stock. Okay, to really see just how powerful this preferred status is, let's walk through a quick real-world kind of example. This will make it crystal clear. So here's a scenario that happens all the time. Let's say Company X raises $1 million from investors, and in return, they give them preferred stock. Fast forward 3 years, and the company gets sold. Now, after they pay off all the loans and creditors, there's only $900,000 left over. So, the big question is, who gets that $900,000? Well, the preferred stockholders do. They get all of it, every last penny. Now, sure, it's not the full $1 million they originally invested, but because they're first in line, they get everything that's left. And what about the founders, the folks with common stock? They get absolutely nothing. Zero. A big fat goose egg. Why? Because there wasn't even enough money to pay back the preferred investors in full. The line for payouts stopped right there. And that, right there, is the harsh reality of how this all works. But wait, there's more. Getting paid first is just the tip of the iceberg. Preferred stock usually comes packed with a bunch of other special powers. Like, you see anti-dilution rights on this list? That protects an investor if your company's value drops in a later funding round. Or how about control rights? That can give them the power to veto huge decisions like whether or not to sell the company. Seriously, any one of these can be just as important as the company's valuation. All right, Section 2, investing in the future. Or, as I like to call it, kicking the valuation can. So everything we've talked about works great if you can agree on what a company is actually worth. But what about a super early stage startup? You know, the ones that are basically just a great idea on a napkin. How on earth do you put a price tag on that? I mean, seriously, how do you value a company with no product and no revenue? It's really, really hard. And this is a classic problem for startups. Arguing for weeks about whether your little idea is worth $2 million or $3 million, it can kill the deal before it even gets started. This whole mess created a huge need for a better, faster way to get these early deals done. And the brilliant solution that came out of Silicon Valley is the SAFE. It stands for Simple Agreement for Future Equity, and it is a genius invention. It basically lets everyone sidestep the valuation argument. It's a contract that says, hey, let's not fight about the price now. Let's just agree that you'll get stock later on, and we'll let the big shot investors in the next round figure out the price. It's a way to kick the can down the road, and it works.
Now, you'll often hear the SAFE compared to something called a convertible note, which was kind of its older cousin. But there's a huge difference. A convertible note is technically a loan. That means it has an interest rate that adds up over time and a maturity date when it has to be paid back. The big game-changing idea with the SAFE was to just get rid of those two things. No interest, no maturity date, it's not a loan at all, it's just a simple promise for future stock. So much cleaner.
Okay, let's move on. Section 3 is all about debt, revenue, and returns, the alternative paths. Because here's the thing. Selling ownership in your company, whether it's right now or sometime in the future, isn't the only game in town. There are totally different ways to raise money that work very, very differently.
Now, one really interesting option is something called a revenue sharing note. Check this out. With this kind of deal, an investor gets a percentage of your company's revenue, not your profit, your revenue, your top-line sales. This is huge because it means investors start getting paid back as soon as you start selling stuff, and they don't have to worry about how much you're spending on office snacks or anything else.
So you can see the trade-offs pretty clearly here. For you, the founder, the big win is that you're not giving away a permanent piece of your company. This deal has an end date. The downside, you're paying them back right away, out of your precious cash flow. And for the investor, they get their money back way faster than waiting for a big exit. But their potential reward is capped. They're not going to get that crazy 100x return if you become the next big thing.
And then, of course, there's the simplest option of them all, a plain old loan. You might see it called a promissory note. It is exactly what it sounds like. You borrow a chunk of cash, you agree on an interest rate, and you promise to pay it all back by a specific date. That's it. Couldn't be more straightforward.
And the appeal here for founders is super obvious, right? You give up zero ownership, none. No dilution, you keep full control. So what's the catch? Well, that payback date is like a ticking clock. It doesn't matter if you're crushing it or barely surviving. That money has to be paid back on time. And that can be a whole lot of pressure.
All right, final section, choosing your company's path, the big takeaway. So let's recap. We've looked at common preferred stock, we've talked about safes, revenue sharing notes, and even simple loans. That's a lot of options. With all these tools out there, how in the world are you supposed to pick the right one?
You know, Mark Lee Roderick, the author behind our source material today, really nails it with this quote. He says, don't be fooled by labels. And that's the key. All these things we've talked about, preferred stocks, safes, they're just starting points. They're just templates. You can tweak and customize them in a million different ways to create the perfect deal for you and your investors. So here's the bottom line. There is no one-size-fits-all best security. It just doesn't exist. Every single one of these is just a tool, and each tool creates a totally different balance of risk, reward, and control. This is a massive decision with huge consequences down the road, which is why trying to do this without experienced legal and financial pros by your side is, well, it's just not an option. It's absolutely non-negotiable. Because in the end, this decision is about so much more than just the legal jargon on a piece of paper. When you choose a security, what you're really doing is defining the kind of partnership you want with the people funding your dream. So, what does that look like for you? Are they true partners sharing in the long-term journey of ownership? Or are they more like lenders, providing fuel for a specific return? Really thinking about that? That's the first real step you take in building the future of your company.